Hello YouTube family, how are you doing today? So in the last video we discussed systematic investment plan, SIP. So I explained all the basics of SIP, how, what, why of SIP. If you haven't seen that video, I'm going to drop the link in the description below, so be sure to check it out. Now today we are going to compare two very major styles of investing, SIP versus lump sum investing. SIP investing means investing small amounts at a regular intervals of time, and lump sum investing means investing a big amount once. So SIP छोटा amount हर regular period of time में, lump sum बड़ा amount एक साथ. Now before starting, I'll always like to mention that in stock markets nothing is good, nothing is bad. Everything has its pro and its cons. So you have to decide what suits you the best. So if you are one who thinks SIP is the only way for you, think again. If you are one who thinks lump sum is the only way for you, think again. So today we are going to discuss all the differences between it and which should you prefer in what situation. Fair? Let's start. Now the first difference, as we can see, is price averaging. Now, like I mentioned in the earlier video also, that SIP has always low risk compared to lump sum investing. Now how does the price averaging take place here? Now if you buy a share at 10 rupees, then you buy that same share at 100 rupees. What is your average buying price? 55. In the second situation, where you buy your share at 100 rupees and buy that same share at 200 rupees, what is your average buying price? 150. The same concept works in SIP. You invest every month, irrespective of what the price is. You invest every month till here, till here, till here. Now you will see, if supposedly you sell, let's assume this is a sell point, right? Now you will make an average buying price which will be here. Now when you sell, your profit will be this much, right? Now in lump sum, what if you invest here? Your profits are more than double. Or what if you invest here? Your profits are comparatively half. Or what if you invest here and your profits are negative? So this is the difference between SIP and lump sum. SIP gives low risk and low returns. Lump sum investing gives high risk and even higher returns. The second difference between the two is the skill set. Now in SIP, you do not need any skill set. You do not need to time the market. One does not need to do research or study in the market. One does not need to have a skill set in stock markets. Whereas in lump sum investing, you need to time the markets, you need to do your research and study, and you need to give this time, you need to develop a skill set in stock markets. In SIP, you can only earn in the long term. As you can see, this equation of price averaging will only work in the longer run. And when I say longer run, I mean a minimum of 3 to 5 years for decent returns. Whereas in lump sum, you can get returns on both short term and both long term, right? You can get returns on any of the time frame. Third difference which we can see here is the emotional balance. Now guys, this is very important in stock markets. Stock markets on paper are easy, but in reality are different. What is the difference among them? Emotions. And emotional balance is very important in stock markets. More than intellectual IQ, you need emotional quotient, right? So in SIP, your emotional balance is higher because your mindset is just to invest every month irrespective of the price. चाहे market ऊपर जाए नीचे जाए, भाई मुझे तो invest करना है, right? But in lump sum, when you invest, you face the volatility. फिर market ऊपर, फिर you see your capital going 30 times or finishing completely. I am using very extreme terms, so maybe 10% above or 20% above or 5 to 6% down. It can be anything. So to face the volatility in SIP is much easier compared to facing volatility in lump sum investing. So in SIP, you have a better emotion balance than lump sum. Again guys, if you ask me what do, I never trade SIP. I only invest or trade in lump sum investing. Why? Because I am looking for those higher returns. I am spending my entire time in stock markets, developed a skill set here, and I do research and fundamental analysis. So I always invest in lump sum because SIP, like you saw, would not be fruitful for me. Now, if you're in a position where you just want to invest in markets and you cannot give much time or you don't have much knowledge about markets, my friend, SIP is the way for you. But you need to decide what do you want to do SIP in. That itself is a separate debate, but SIP is the best investment method for you. Or if you're a person who wants to develop a skill set in this line, if you want to give time to stock markets, if you want to make a career in stock markets, then my friend, you need to start doing lump sum investing. Right? So here are the two differences between SIP and lump sum investing. I hope you found this video helpful, and that was it for today. And if you think this video was helpful to you now or in the near future, don't be afraid to help us out by clicking the subscribe button, and we would love to have you in the family. Till then, bye bye.